Welcome back to week 3 of the Investor's Guide to Thriving. We've been really amazed by the attendance on these webinars and the heartfelt feedback we've received from so many of you. Helping people have better financial outcomes so they can live better lives is why we do what we do. Speaking of what we do and when we do it, this week we moved the webinar to Saturday and there was no BermansCall on BNN on Thursday due to the Passover holiday. Next week, Larry will return to both BNN and the next edition of Investor's Guide to Thriving on Thursday the 16th. This week, I want to speak briefly about the nature of the strange times we're in and what they might mean for us going forward. Wei Ji, the Chinese word for crisis, is often misquoted by motivational speakers and even President Kennedy as being composed by the characters for both danger and opportunity, but that's not quite correct. Its original meaning is danger at the point of juncture. It can be understood to mean a point where things happen and change, a changing point. In mathematical terms, we call it an inflection point. At such a time, we might expect a paradigm shift, which can be described as a radical change in personal beliefs, in complex systems or organizations, replacing the former way of thinking or organizing. Think about what's possible now that wasn't just a few weeks ago. If somebody stood up in Ottawa and said, hey, let's spend $100 billion right now on massively improving the efficiency of our healthcare system, that idea would be ludicrous. It would have no political support. But now, that's the immediate taxpayer cost of just 1 month of keeping our economy closed. And why? To prevent our healthcare system from being overwhelmed, leading to otherwise preventable deaths. Now, $100 billion to save hundreds of billions more seems a completely rational investment. That's just one example of how an event like this shatters the status quo and sets up new possible ways of thinking. Roy Amara is best known for coining Amara's Law on the effect of technology, but Amara's Law can be readily applied to many things that change the world. So we tend to overestimate the effect of change in the short term, but yet we underestimate it in the long term. And perhaps that's a good model for how markets have reacted to this. The most rapid decline in history, followed by a rally that has caused many to believe that we'll just forget about 2020, skip over it, and look forward to a completely normal 2021. We're struck by the number of questions coming in this week about the possibility of a rapid return to normal. Larry will discuss on today's webinar how this anticipating of a return to normal typically plays out in bear markets. There's a saying that a rising tide lifts all boats. People confuse brains for a bull market all the time. How investors handle the inflection points is what will really determine their long-term performance. And these are the points where we see a paradigm shift in how people approach their investing. Perhaps it's time to revisit your financial plan. Perhaps it's time to get a little help navigating difficult markets. That's one of the reasons Larry and I founded ETF Capital Management before the last major financial crisis in 2008, 2009. We provide portfolio services to clients with the need to manage $1 million and up, and we've partnered with BMO to offer ETFs and funds of ETFs for those still working on their first million. You can learn more at etfcm.com and zzportfolios.com. We can also help with dedicated financial planning through upotential.com. For those who want to catch the webinar replay or download Larry's slides, tomorrow morning you'll get a short email survey. Tell us how we did this week, and you'll get a link to access all of the above and submit questions for next time. Investor's Guide to Thriving, as always, comes to you at no cost in favor of 2 causes that Larry and I believe in passionately: Sick Kids and the Baycrest Foundation. We hope you can join Larry and I in supporting childhood leukemia research at Sick Kids. And we also appreciate your support for the groundbreaking research being done by the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you so much. And if you would like to make a donation, please use the links in the survey you'll receive after the event. Thank you also to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO ETFs has been our partner in all things ETFs, including Investor's Guide to Thriving, for over 10 years now. They offer a wealth of knowledge for investors, and no one is a better example of that than our good friend, Mr. Kevin Prinz from BMO ETFs.
Thanks, Jared. Appreciate the introduction there. And let's just jump right into it. What we thought we'd do today is give you some background around diversification, specific asset location. Before I go into that, I want to quickly highlight some key trading rules for everybody out there. And those key trading rules are for the first 15 minutes or the last 15 minutes of the day, probably best not to trade. It takes a little while for the market to get orderly. So be careful during those first 15 and last 15 minutes a day. And I'll also highlight that whenever you trade, always place limit orders into your purchases or even your sales for that matter too. So let's talk a little bit about asset allocation. This is a famous study, and I thought we'd give you some background because Larry does talk about different assets, and this is some of the reasons why things come together. And so certainly asset allocation being the key factor in there. 91% of the volatility of your portfolio, that's the movements up and down on a quarterly basis, is based upon the volatility, based upon your asset allocation. In addition, I'll highlight that your performance, Ibbotson studied this too, and about 100% of your performance comes from that asset allocation. And when I'm talking about asset allocation, I'm talking about this. This is what we like to nickname as a jelly bean chart in our industry. It's kind of fun because lots of colors, but really what I'm trying to show you here is that over the years, different asset classes and different markets tend to perform better than others in different marketplaces. So having a diversified portfolio allows you to ride some of the ups, but also mitigate some of the downs in the marketplace. And what you're also seeing here is not only the different asset classes and the particular markets, you're also seeing a gray box cascading through the middle, which is showing you your typical traditional balance mandate 60-40 in that space. Now, flipping to the next slide, what I want to show you is kind of how they've done in the more recent marketplaces, because what we've seen definitely in the more recent timeframes is that sometimes that traditional asset allocation diversification benefits sometimes go to the wayside because the demands of liquidity. Well, we're still seeing some benefits here in liquidity in the more recent marketplaces. So this is a year-to-date chart, taking a look at the three more popular diversified portfolios. That's the Z-BAL, the V-BAL, and the X-BAL in the marketplace. And I just did a simple comparison to the S&P 500 unhedged and the MSCI EFI unhedged too. And what you are again seeing is the diversification benefits across the board. And then if you look at more of the longer term, which you see in the 1-year chart there, you're seeing those benefits kick in a little bit more, even though we have some half-decent downs in the more recent period. Let's take a look at actually what it looks like in a graphic line and flip the next thing. These are just 3 ETFs. Now I'm taking a look at not just the balance mandates, but I'm looking at a conservative mandate and a growth mandate and the balance mandate. And what you're seeing, as you would expect, your conservative mandate has behaved a little bit better in these markets, your balance mandate a little bit further down, and of course your growth mandate, the more challenged of the 3 in that marketplace. And you would see that from any respective provider out there. But that's part of asset allocation. And the nice thing is what I'm highlighting here is that you can build portfolios yourself with ETFs, and that's one of the benefits of ETFs, the individual broad markets, the asset allocation, or you can use a basket portfolio, or you can even use some of the factors in a second. I'll show you that. One of the other things that Larry likes to talk about when he's talking about diversification, this is probably one that probably really helped out the most more recently, is currency. And you can take ETFs in Canada and hold them hedged or unhedged. And what I'm showing you is hedged and unhedged. The ZSP is unhedged. So the buoyancy of the US dollar in this current correction certainly helped that particular ETF stay up more than an unhedged ETF, which is ZUE. Because effectively, when you think about currency diversification, what you're getting with an ETF is you get the actual markets, but you also get currency exposure if you're unhedged. You can get rid of that currency exposure if you move to more hedged ETF. Again, choices on building portfolios through ETFs. And then in addition, my last keen slide for everybody here is not only can you use ETFs to build portfolios, asset allocation, as well as broad markets, but you can actually bring in different factors in the marketplace. So quite often, more recently, you're hearing more about quality companies out there, the companies with low debt to equity, good return equity, good stability of earnings out there doing well in the marketplaces. But at different times, you might see dividends. And these are just rotation aspect of various quality different factors and different types of ETFs out there. So not only, again, can you hold broad markets in ETFs, but you can hold factors and diversified portfolios out there. Ultimately, all these things are key tools to building portfolios out there. And I recommend you take a look at all the service providers out there and how you can utilize these to build portfolios in the current marketplace. And last but not least, I'll quickly highlight, if you're looking for some detailed insights around ETFs in the current marketplace, one thing we've done recently with the TMX is hold a weekly webinar. Information will be coming out with this on the survey at the end of this session. Let me hand it back to Larry, and thank you for your time.
All right, thanks very much, Kev, and welcome everybody. I'm going to try to get to as many questions as possible. I've answered some of them online already, and folks, as you can imagine, I'm not going to be able to get to all of them. I do want to, as much as possible, give you as much insight into what's going on in the current environment as possible. And I hope to leave at least half hour for questions at the end. We have some that people have already emailed in, and I'll try to get to as many as the online as possible. As someone who runs sleep at night portfolios, I always talk about what keeps me up at night. So I'm going to cover a little bit of that. I'm going to cover some of the Federal Reserve actions in recent weeks and what that means for markets. I want to talk about what the world is going to look like in the post-COVID environment, and give you some tools along the way. Each of these weeks, I'm trying to freshen up, put new charts in, new things, but some of the things we've talked about in past weeks are similar. So, last week I looked at this graphic here on the upper left, and what it is looking at the data that comes out of the Bureau of Economic Analysis and the income that the U.S. government takes in. So this is based on corporations. So this is corporate profits after tax, adjusted for inventory swings and capital cost appreciation. And what that line shows you over the years, and with all the recessions highlighted, and I've blown up the last number of years here, is that basically the amount of revenue U.S. government is taking in based on what companies are actually reporting in their earnings has not grown in 7 years. And this is a big, big structural, fundamental problem about the world. And for years now, people are saying, Larry, you're too bearish, you don't get. This is one of the charts on why I've been so concerned about this market, and frankly, folks, the house of cards that's been building up here. So there's a couple things in play. And one of the big ones here is what's happening in the corporate debt market. And for an industry like airlines, for example, that's been a massive, massive abuser of taking their earnings and buying back shares with the sole goal of boosting earnings per share. And well, that's not a bad thing in and of itself. It is when the motivation of it is enriching the C-suite, where the vast majority of compensation that the senior executives get is from stock-based compensation. What's good for the economy is when a corporation says, okay, I've got earnings, I can retain those earnings, I can pay them out in dividends, or I can buy back my shares. Those are the things that we can do, or we can reinvest in our company, not by buying back our shares, but by hiring new people, increasing market share, expanding capital expenditures, and expanding R&D. For the last 15 years, the amount of R&D spend, the amount of CapEx has been shrinking and shrinking and shrinking. And what we've seen in this era of low interest rates is the credit spectrum, the quality of debt, the size of the balance sheet. So in the middle chart on the bottom here, you've got non-financial. So when we say non-financial corporate debt, we're not talking about the debt that a bank issues so it can lend out more money. We're talking about a corporate that's non-bank, non-financial, and the outstanding amount of debt as a percentage of the size of the economy. And you can see on that line here, and what has happened over past recessions when we go through a deleveraging. So debt has never been higher. The quality of debt has never been worse. And what the Federal Reserve did on Thursday was launch a massive support for this. So you've got the C-suite, and there's an ETF, and I encourage you to go look at it. SPYB. I've put a link there to the holdings. These are the industry sectors that are most exposed. So our financials are a big buyback. But what I want to show you here is these buyback companies that Kramer and others, buy. And so they created an ETF. And that ETF now has underperformed dramatically compared to the broader index. And I believe corporations that have gone out at the expense of a worsening balance sheet, and you can see here the graphic on the upper right, and this is the basic amount in billions that they've bought back shares in the last 2 years. And there you can see with the Trump tax cuts what they did with their money. They bought back more shares. 5 trillion since the last crisis, 5.25 trillion, if you add up all those blue lines, has accounted for 2 or 3 multiple points on the S&P. So what that means is approximately 300 to 450 S&P points alone have just been share buybacks. Had the corporations been paying those out in dividends or investing in R&D and CapEx to grow their businesses, to grow their market shares, and they haven't. And that's why revenues aren't going up, because what they're reporting to us is BS pro forma numbers. It doesn't include stock-based compensation. It's all got all these below the line, one time we fired a bunch of people, we're not counting that nonsense. It's not real. So, you've had this period now over the last decade of free money, and I believe it's going to come to an end. I believe we are going to see buybacks become taboo. And this is an important theme we need to follow, because I do believe in a very big way that companies that have gone to the trough, where the C-suite has been, I would call it bordering on criminal. Listen, I'd love to see the airlines, all of them go bankrupt. And not because it would cost jobs. We don't want that part. But those airplanes are still good assets. They're going to keep flying. These companies should go bankrupt and restructure, and at the cost of the equity holder. I believe that 100%, that a lot of these companies should be punished and not getting the support. Now, the airline industry to me is a utility. We need it, right? It's part of our everyday lives, business travel, vacation. So you don't want, but how the C-suite has governed themselves, folks, has made me sick to my stomach. And the cheerleaders on Wall Street trumpeting this, to me, is complete and utter BS and nonsense. So, if you want productivity, if you want real economic growth, corporations should be investing in their people, in R&D. That, to me, folks, is real. That, to me, folks, is bullish. And we've had an era of financial engineering, and folks, it's over. And if it's not completely over, it's ending. So a couple of weeks ago, the Fed fired the big one. So they came in with a massive stimulus package, and Forbes wrote it up on March 16th. There's a link there if you want to read the article. They called it the big one. Folks, what they did on April 9th, to me, is an all-in move. They've shoved all the chips in. There's no limit to what the Fed will do here, including buying falling angels. And what falling angels are, folks, these are the companies that had disregarded the balance sheet, had bought back their shares. They were sitting at BBB status, one notch above junk, and have recently been downgraded to junk, like Ford, for example, and like some of the airlines, if they haven't already, will be. And they've stepped in to buy them all, in large point because they've told everybody, listen, you got to stay home. And so there's this moral dilemma, if you will, because we've been told we can't go out and do things because of the virus. So there's a degree of wanting to support the workers, not the companies, but the workers. And it's been, they got to support the companies a little bit too. And so they've thrown everything in. I mean, the balance sheet of the Federal Reserve in the last couple weeks has gone exponential. And with all these programs they've launched, is going to be somewhere between $9 and $10 trillion by the end of this year. And to me, folks, this is tremendously bullish for gold. There's two aspects to this. There's the deflation. So what's happening now is extremely deflationary. All this money that's getting put into the system is not going to cause inflation. And the reason it's not is because our incomes aren't going up. All this stuff is bridging. It's not giving people more money. And until people have more money and are willing and capable of spending it, and if anything, people are going to increase savings rates here. They're going to get more conservative, like we've seen coming out of other crises, at least for a number of years. So for the next 2, 3, 4 years, we've got more of a deflationary shock. But that means bond yields go close to zero, if not negative, and that is bullish for gold, because gold doesn't pay an interest rate, and if bonds aren't paying much yield, gold has no competition. But an eventuality out of this in the post-COVID world will be significant inflation, but not so much because of the money printing, and I'll talk a bit more about that. But make no mistake here, the Fed is all in. I've been asked, are they going to now buy stocks? And the answer is no, not now with the markets firming up. But if, as I expect, we have another major leg down coming, it would not surprise me, like the Bank of Japan has been doing, if they come in and start buying real assets in terms of equities, ETFs, things like that. But that's not a reason today, folks, to buy the market. So again, a little bit on sleep at night here and what it means to me and what you can expect when you're investing alongside of me, whether that's in ZZZD here or in one of the other funds we run, or if you're a client for that matter in our custom portfolios we do for individuals. So the standard deviation, that's the volatility day to day. What we've done in the almost 7 years now since we've been running the BMO Tactical Dividend Fund, only been in ETF format a little over a year now, the average daily standard deviation is 0.48. And what that means in English, a VIX reading, folks, of 10 is a standard deviation of 0.63. And a VIX reading of 15 is a standard deviation of a little less than 1%. So the world index, the benchmark for the world, VT, 0.83. So that's a VIX of around 13, okay, in the last 7 years. And we've been in a period of suppressed volatility. But what you end up seeing is more consistent returns with less volatility. And that's what I mean by sleep at night. So the next graphic here shows you the 3 funds that I manage for BMO and relative benchmarks and what we've done. So for example, our balance fund has the ability to go to 80% equities to 20% equities. I treat it as a total return strategy, not a hedge fund. There's no leverage, so I can't go short, but I treat it like a total return strategy, meaning I'm always trying to generate a yield and a return that would be similar to one of those balanced ETFs. So you get the experience of a ZBAL or a VBAL or an XBAL type traditional portfolio. The problem with those are that interest rates are basically at zero. So 20, 40, or 60% of your portfolio is impaired. There's no yield, basically. So I think even those passive ones, even though I like them, and I recommend the simplest solution for most people is to use the ZCON, ZBAL, and ZGRO. And when you're concerned about risks, so as an example, when the CNN money thing indicator, which I'll talk about, is at maximum greed, go to the ZCON. Take less risk, have more fixed income, more sleep at night in your portfolio, less equities. And when you're neutral, go to your balance, 60-40. And when things are depressed, like they were a few weeks ago, then you go to your growth and your ZGRO and get more upside. So again, looking at all three of these things, and for some of you, it might be 100% equities. There's some ETFs you can go grab 100% equity exposure, or you figure out which one you need long-term and you give me the money, so to speak, through one of the funds that we manage to manage that ride for you. So the white line at the top, that's our balance fund. And you can see here year to date, it's just up. This was as of the close of yesterday or of Thursday. So the balance fund is up, okay? Now the benchmark, which is ZBAL, that's 60-40, that's down 6.2. And then you can look at that one, which is the orange line, and you can see the ride. So just less volatility. Well, how about the growth portfolio? Well, last year I said on BNN and in our fall roadshows that I had not been more bearish in my almost 35 years in the investment markets. And it started when I was in university selling mutual funds, believe it or not, RESP plans while I was in university back in the mid 80s. And so the Tactical Global Growth Fund had very low, this is a growth fund, this is a global growth fund, but I can grow your money being in bonds, I can grow your money being in gold, I can grow your money in all those assets and factors that Kevin talked about in the opening act of the presentation today, to do other things that have less correlation and less type of returns. But overall, my risk levels were as low as I've ever had them, okay? And so what did the growth fund do? Well, let's look at that yellow line. So at the worst, when the global equity markets were down 30, 40%, we were down 10, a little, maybe a touch more than that. And where are we now? Our growth fund is down 4. The entire world, VT, the Vanguard total world, every stock in the world, down 17 as of Friday's close. That, folks, is sleep at night. And if you like the ZZZD because you want the dividends and you want the regular monthly payout, that fund is down almost 11%. And while you're not happy with that, believe me, I would love to be up, down less than that. But the equivalent benchmark, which is the iShare Global Monthly Dividend ETF, CAD hedge, is down 23.4. So folks, that's sleep at night. When I talk about sleep at night, I'm delivering you a better average return with less risk. No downside. So I talk about the 2008-9 playbook. And so this week I added this bottom part in, and you can get a better graphic view of what I'm talking about. There was a question that came in that I saw. People say, well, this is not the 2008, and we're not getting the same. Well, this, to me, folks, this is identical. So what I've done is I lined this up with not the first part, not the beginning of 2008 and 9, where we had the Bear Stearns bankruptcy early in the year. The recession started, in January of 2008. I'm showing you the view of the post-Lehman world, because volatility didn't spike in 2008-9 until the middle of September 15th, when Lehman went bankrupt. And that's when the carnage started. And that's where VIX under 20, VIX 20, 25, 30, 40 on a spike, those are buy the dips. Once VIX gets over 40, folks, you're not in a buy the dips. You're in a catastrophic period of volatility where you've got a VIX of 80 is a 5% daily move, an 11% weekly move. Okay, so if you want to calculate what the expectation of VIX is, you take the net level of VIX, you divide it by the square root of the number of trading days in a year, or if you want the weekly number, the amount of weeks, and that gives you the number. So we closed the week with a VIX of a little over 40, but around 43. And a question came in, does that mean it's a buy opportunity? Well, look what happened in the months following the initial spike in volatility, right around the time when they passed all the TARP packages and stuff. And so you had this massive spike, or a couple of days and weeks there with spikes of VIX into 60, 70, 80. And then things calmed down for a while. We got a counter trend rally. That counter trend rally went from about 850. So you can see the initial spike down in early October down to about 850, the red bar there. And we bounced a little bit and we came back and we retested that and we rallied again. And then, even though VIX came down to 40, it spiked up again and as we made new lows. And then going into early 2009, VIX never got back to those extreme periods. Why? Because as time passes, more certainty comes, more clarity comes in. There's less question marks. There's more support from the Fed. But the markets kept going lower as we realized what the economic damage was going to be. And that part of the cycle we haven't seen yet. So we've got our initial snapback, we've got all the support, but if you think that we're going higher from here, you're absolutely insane, okay? And not to disrespect anybody's opinions, but this is part of what's called the hope rally. I tweeted about this week. This is the part of the rally where, oh, you know, yeah, this is because we've been trained for a decade now, folks, to think V bottom. And V bottom is correct if VIX stays under 40. Once VIX goes above 40 and your expectation of daily volatility is more than 2.5%, you're selling rallies, you're not buying dips, okay? I can't emphasize that enough. It's such an important thing to understand about markets. So let's look at the fear and greed index. And people are going to say, oh, it's back at neutral. So it's still tilting towards fear. But let's look at what's in it. So you look at the VIX and you say, well, how far is the VIX away from its 50-day average? So that's one of the factors here in terms of that indicator. And obviously, as VIX has come down, that's moderated. Well, what's happening in the put-call ratio? What are the speculators doing in the option market? Well, it turns out they're starting to buy some calls because people are speculating that everything's fine. How about market breadth? Well, obviously markets have come off their lows, so stocks are starting to rise. How about the difference in returns between stocks and bonds, the number of stocks making highs and lows? This factor number 6. What's gone on in junk bonds and corporate bonds and high-grade corporate bonds? So those two ETFs represent junk bonds and liquid corporate bonds. And because of all the Fed support, and now they've gone in to buy junk bonds, that spread has collapsed in a little bit. And then how far is the S&P from the 6-month average? Remember, 252 trading days in a year, so 125-day average on price is 6 months worth of trading. So all those things have neutralized because the markets snap back. But big picture here, folks, have we solved anything? Is there a vaccine? Are we past the economic damage? So how this economy recovers is in stages. Best case scenario, restaurants open 2 or 3 months from now, and you can't have more than 4 people at a table, and they generally should all be from family, and you're probably going to have to wear a mask to do that. And then it's every 3rd table, and 20% of the restaurants will be out of business at that point because the owners just won't be able to make it through and so forth. So, you know, that part has yet to play out. And it's a very, very big thing here. So, you know, where's the bottom? This is the question. You know, was a lot of people tweeting, oh, you know, I love Donald Trump, whatever it is, the April 23rd or the March 23rd bottom, that's it, out to lunch completely. The economic fallout here, folks, this is the worst hit to employment since the 1930s. And if you think we're coming out of this quickly, again, I got to question your judgment. So this is going to be severe. It's going to last 2 to 4 years before things even remotely come normally. So let's look at 2008 and 9 and how it played out on an earnings basis. Because ultimately, we pay for earnings. So this graphic here, new graphic here, I'm showing you the recession period in 08 and 09. The upper line on the bottom graph, the orange, that's expected earnings from analysts versus the actual trailing earnings, the green line. So when we look at back then, we can see that earnings, it took a long time for earnings to come down, a better part of a year, year and a half, 2 years, in fact, from peak to trough earnings. We'll see something similar this time around. And as things recovered, and initially they recovered relatively quickly, but again, from the 2007 and early 8 peak in earnings to recovery was about 3 or 4 years, okay? So earnings, remember I said, since 2013, the revenue and what corporations are paying tax on to the government hasn't gone up. So what's happened to boost markets? Well, the multiple has expanded significantly because, as you can see, earnings growth after 2013, after the initial phase of the recovery, was pretty flat, 110, 120. It wasn't until the anticipation of the tax cuts that came in 2018. And when 2017, that jump in earnings there, 50% of earnings in the S&P 500 come from foreign corporations. So when the US dollar depreciates, and you can see that line in 2017, that's the US dollar index, and I've blown that up to overlay against the S&P 500 at the top. So when the US dollar depreciated in 2017, it boosted earnings. It did not boost real earnings. That was just currency. And now that the US dollar is strong again, it's a headwind for earnings. So the last couple of years, so you got a boost in 2018, and we went, because taxes were cut about 25%. So we went from about 130 to 145 or 155. And today we really haven't gone up more than that. And you can see how earnings stepped up there as the tax cuts came into corporate earnings. But over the last year, we've had no growth in corporate earnings. Expectations are for growth, okay? But those earnings aren't going to come. So in the next chart here, what I'm showing you is analyst expectations. So actual earnings, the last 4 quarters in the bank, line 1, $151.93. That's in the bank, it's already been earned. What I will tell you about those earnings though, 10% have been share buybacks. 10% is because it's pro forma, non-GAAP, so not real earnings, BS. And 10% were the Trump tax cuts, which when Donald Trump loses the election this year, will be reversed by the Democrats. And 2017 was FX gains. So best case scenario, the base earnings level is at least $120, okay? And what is the multiple you pay? So at the peak, only a few months ago, not even, S&P at 3,400, we were trading at 22.5 times trailing earnings. And at the time, because expectations for earnings on a forward basis, and you can see on the graphic here, line 11, so the now, only because this last week, okay, in the far column, forward 12-month estimate is now starting to look for a decline in earnings, but really flat. You can see the year-over-year number in the actual on line 1, 151.93 versus 151.19. So it's only just started to turn down. So forward 12-month, the multiple's 18. Now, in the world we're heading into, where we come back, and when we finally come back, it's at 60% economic growth or economic capacity, 70, 80, 90, over the next few years until there's a vaccine. A vaccine is 12 months away minimum. Once we have the vaccine, things can start to normalize. But until we get there, there's not a snowball's chance that economic activity recovers. All this support is bridge. It's just replay. There's no new money here, folks. It's just replacing lost incomes. It's just helping corporations refinance debt so they can get through this awful, awful, awful period for humanity. There's no new stimulus at all. Now, the next bill is going to be infrastructure, and that'll be trying to put people back to work. I'm not going to talk about that today at all. But you can see a year out and 2 years out, they expect earnings to be growing. And based on what happened in 2008 and 9, that is completely insane. So the markets are still grossly overvalued fundamentally. This is not an earning you want to buy, market you want to buy into, okay, at all. So where do earnings bottom? So the cyclically adjusted PE, the Shiller PE, okay, this is the ratio of the 10-year average earnings smoothed out. And when you look at where we are today, we're still very, very expensive compared to the recessionary troughs of past cycles. All these gray lines are recessions. So the multiple in a recession, folks, historically 11, 12, 13 times earnings, okay? Coming out of this, we're looking at a period, perhaps for a decade or more, not unlike the 1970s, because I've been really upset with the amount of debt accumulation, and the growth in the world has been all leverage, and now it's only getting worse. There's even more debt coming into the system. The US debt to GDP now, this year, add another 4 trillion of debt to the US, 24 trillion on an economy that's now running at about 16 trillion in terms of its size. So your debt to GDP in the US now is 150. And with the amount they're going to have to spend in the next few years to revive this thing, it's going to be 200% of GDP. And then there's all the unfunded promises for healthcare and Medicare and Medicaid and social benefits. It's catastrophic. It really is. Taxes are going to have to go up. This is not going to be good for growth. We're at the end of globalization. Supply chains are going to be rationalized. Money is going to come back home. So ultimately, Trump's going to get his wish and put up walls. But this is not a good thing. This is going to push cost up for Walmart and everybody else who sources supplies globally. And this is very, very real. It's going to lead, in my humble opinion, humble educated opinion, to a decade of stagflation. And so we're going to have price pressures going up because costs are going to be rising, but we're going to have extremely, extremely sluggish growth because of the massive amounts of debt. And I just, there is not a lot of wiggle room here. So on a technical front, where's support coming in? So let's say 120 is the normalized earnings number. And the multiple is not the discount that I talked about, 11, 12, 13, but it's the long-term average of around 16. That at a very minimum tells us next year's 2021 number is 1920 for the S&P. And to me, folks, that's the minimum downside before I think about answering the question, is it time to buy? But I could paint you a scenario that's way worse than that. So if we go back and look and realize that earnings fell about 50%, and let's say the 150 number is real. It isn't, but let's say it is. That would imply earnings bottoming out around 75. Well, when earnings bottomed out in 2009, the multiple at the bottom, 666 on the S&P 500 times 11 multiple, was that earnings level of $60. So if 120 is the base and we're down to 60, you get a retest of those lows in 2009, and that's very real possibility. So if earnings get cut in half, worst case scenario, we do some kind of averaging. Like I'm making up numbers here, folks. There's no right number here. We don't know what that multiple is going to be. It's going to be what it's going to be, as Andrew Cuomo likes to say when he's talking about some of the numbers. We'll let the virus dictate. So whether it's 16 times or 11 times, worst case scenario is we're somewhere between the lows of 2009 and call it 1,000 or 1,100. But technically, there's no support. There's no chart point. There's no nothing that's even remotely important if we go below the highs from 2007, 2008. markets. So 1550, 1570. I've drawn that white horizontal line across the chart. Now on a retracement basis, there's a zone of support between 50 and 61.8. Those of you who follow the technicals know all about the Fibonacci's, and that comes into that range. That 1920 target is in that range. So more than likely, somewhere in that range is where we bottom out, okay? But it's in that range. It's not at 2,800, 1,000 points above that range, okay? Now, what do you do in an environment like this if you want to participate? You can day trade, but I don't recommend that for most people. This is not the time to bring your shopping list out. This is the time to use interesting products that are alternatives, that give you a different type of return. Here's one of my favorite ETFs. I've used it. I don't own it today, but I used it this year to hedge, and it really helped the sleep at night portfolios, all three of them. I had it in all the funds. And this is an ETF that's long 200 low volatility, lower risk stocks, less economically sensitive. BMO's got a whole line of low vol ETFs, but at the same time, it's short 200 high beta, high volatility, higher risk ETFs. And so it gives you an overall negative correlation to the market. And as you can see in the last couple of years, it's actually done very well. The white line at the bottom rising, okay? But in the market up move, that basically has been up until the peak in 2018, this ETF did terrible. You don't want to own that market neutral strategy when things are generally bullish. But during the dips, and you can see a couple of them over the last number of years there, this ETF did very well. And it'll do well in the next one, and next one, and next one. So it's a defensive holding. You can make money in a bear market by holding something like this. It's better than sitting in cash that pays you nothing. But you got to know your products and your tools, folks. I love these ETFs. They're with option strategies. The problem with a simple covered call strategy is that when the move is so acute and fast and rapid like this one was, you get no protection from it. And as it turns out this time around, dividend stocks got hit way harder than most of the other ones. And so that didn't work out well for a pure covered call strategy. So I asked BMO, I said, would you create an ETF that looks like the purpose one that does something similar? And the PYF has been out for a few years now, and I'm showing that purpose premium yield fund. Look how stable those yields are, those returns are. They write puts on stocks to generate yield, and then once they own that, they write a call to generate yield. It's always looking to generate 5-6% plus yield with less risk, but it's not risk-free. Look at what PYF did as it declined. Look at what ZPAY did this year. It declined, but it's also snapped back. But it's generating, while it's doing that, it's generating you 5 or 6%. So I own a big piece of ZPAY in the sleep at night portfolios. But generally, as a rule of thumb, if VIX is under 40, you want to buy all dips. You want to be less defensive once you've had a correction from the peak of around 13.5%. And in a recession like we're in now, you generally want to be a buyer once you've had an average correction of 29%, which the current one so far has. But we're not 29% down anymore. We're 17% down. That's a big differentiator. And if you are understanding my playbook about still having to price in the economic ramifications of what's gone on here, you will believe and you understand that we have lower lows to go. You shouldn't be fooled by this hope rally. Another thing to look at is another market neutral strategy, DANC. So this is a pairs trade. This is a market neutral where the portfolio manager says, I like Royal Bank, but I don't like Bank of Nova Scotia. I'm making it up. I don't know what they own at the moment. But go look at their website. Okay, so it's the Desjardins alt long short strategy. Go look at their holdings. They're long one thing, they're short the other. So they're market neutral. But if they're good at picking the better stocks, they're eliminating the market risk and they're giving you exposure to the better companies. They're long this oil company, short that oil company. So you're market neutral on a risk basis It's not risk-free. It's not a bond alternative, but it's market neutral. And what you're counting on is the portfolio manager being better than buy and hold. And what I'm comparing this to is holding a money market ETF. And that's the orange line. And the reason that money market ETF had to move up there is because when the Fed aggressively cut rates, T-bills rallied. And so the 1-year bill rallied and you made some money off it. And that's normally a money market ETF wouldn't do that. It would be much more stable over time. But that's why it hooked up like that. Okay. Next one here. These are option-based strategies that they have in the US. They launched a year ago, a company called Innovator, and in Canada here, they launched First Trust ETFs launched similar type products, and these are buffers. Folks, I'm going to show you after this how you can do this on your own, but these ETFs are great because they buffer your portfolio. Again, they don't eliminate the risk. So the April series a year ago, up until a couple weeks ago when I printed this out, you'll get an idea. So the red line is pure long the S&P 500. So you get maximum upside, you get maximum downside. You can buy the buffer version, the B, so it would be the April acronym with the B as the fourth character. That gives you a 9% downside buffer. So from point A to B, so that 1-year expiry, if at the end of the year you're down less than 9%, you will have no loss on that 9. Anything more than 9, you're at risk. And then the P buffer gives you 15% downside, and the ultra buffer gives you protection, not on the first 5%, but on the next 25% after that. But because it's done with an option structure, you have mark-to-market risk. The price of the option changes. It doesn't just stop at that level, and you can see the price performance of all of those. But the yellow line, which is the ultra buffer, the protection of 5 to 30%, actually down the least. You can see it was down a little bit more than 5%. You'd say, well, Larry, why is it down more than 5? Because on March 22nd, it still had a week to go before expiry. But if you actually check when it expired at the end of the month, it was down 5%, exactly. So it does what it says it's going to do, and these are great things to use in the current environment. However, you can do better, but you got to understand how to use options. Folks, this is what we do in our private client portfolio. We use option strategies to hedge risk away. So with an option strategy, by buying a put and selling a call. So the SPY ETF closed at 278.20 on Thursday. You can see the graphic here. What I've put in the chart here is the price of the puts and calls with some of their Greek letters and volatilities. So at the money, line 10, right in the middle, that's 278. So that's right at the money, ATM. So if you were to buy at the close on Friday or on Thursday, a 278 put, the implied volatility, so the expectation of VIX, and this is the December 31st contract, so through the end of this calendar year. The implied volatility VIX at the time of the price of that option was 29.44. Okay, that's the risk factor. So at the money, you're paying $29.47. So more than 10% to protect your portfolio. That's expensive. When VIX is high, insurance is expensive. When VIX is very low, 10, 15, insurance is not expensive. So outright protection right now is very important. So how can we pay for that protection? Well, we can actually write a call. And that call, if we sold it, we'd get $26.54, which would be the implied volatility of 28.09. And you'd say, Larry, why is there a difference? Well, the difference is the yield, because if you sell at the money call and buy at the money put, it's called a synthetic short. It's no different than actually going out and shorting SPY or buying an inverse ETF, SH. They're all the same. The thing is with this strategy, all you have is margin. If you were to actually go out and short it, or which you can't do in a retirement account, by the way. But if you actually went out and bought SH, it would take half your portfolio value. So you can only do it on half, because what I'm suggesting here is you go out and buy what you like. So when the CNN greed index is high, by all means, still own what you like. Buy the stocks and buy the companies and get their dividends. I love the strategy. But what you want to do at that point is hedge. You want to put on a structure like this. Folks, there's dozens of ways you can protect your portfolio with options. And I could spend hours and hours and hours teaching you about this, which we don't have today. But I wanted to identify this because we do this in our portfolios for our high net worth custom portfolios that we do for people. This past week, I've been asking Bank of Montreal for this tool to allow me, because I saw this coming. Remember, back in February, I did the episode on BermansCall where I talked about social distancing and what we were going to have to do here. And I couldn't believe that the market was so benign to this. And I had asked them for the ability to do this. I finally received approval last week. Better late than never, as they say. So even for the BMO funds now, for ZZZD, I've got a structure, an option structure. It's not this one, but it's similar, where it cost me nothing, and I've insulated the downside. But when you sell that call, you've sold away the upside. If the market keeps going up, you get no upside. There's always, folks, there's always a cost to doing this stuff. Okay, nothing is for free. But you can put on an option strategy that you don't have to lay out 10% of your portfolio to do. The cost of that is giving out the upside. But if you're good at picking stocks, if you're good at buying what you like, you're hedging the market risk away, you're hedging the volatility away, and you're still able to earn your dividends. And in this environment, way better than sitting in cash. But when the CNN fear index is high and at an extreme, you don't want the hedges. You don't want these alternatives. You want to be exposed to the bounce and the rally and the growth. So this is another set of tools that I now have in the sleep at night portfolios that are going to even further dampen the volatility and give you even more sleep at night. What's the cost? I'm not going to get the upside traction that we would otherwise get if we're all free and clear here on the upside. But make no mistake, folks, when the markets sell off, I'm going to lift those hedges and leave the portfolios exposed to the recovery. Okay, so let's talk about what we should be buying, or what I'm going to be buying as things play out here. So a couple different themes. I talked a little bit about the world, shutting in and closing. And I think there's going to be a lot less growth, and we're in for an era of stagflation. So where's the growth in the world going to be? I think in the short run, emerging markets are stressed because a lot of the debt that they use to finance is done in US dollars. And as the US dollar is strong, it's detrimental to some of these economies, and their currencies suffer. So when you're investing globally and in emerging markets in particular, currency risk is one of your biggest things. Kevin talked about that at the outset. So with the blank check policy, I think interest rates ultimately go to zero. So long-term bonds are attractive, but in the short run, a massive amount of supply here. So if yields rise a little bit, 25, 30 basis points in the 10-year, I think you can add your duration. I own no duration in the portfolio at the moment. And gold here, I love it. Gold bullion, gold equities, I have a lot of exposure. I'm not adding because I'm not quite full, but I got to see a pullback to add on the most recent sell-off we added. So I like the economies of the world that have better growth profiles going forward. And those are emerging Africa, parts of the Middle East, where the populations, they're 18, 19, 20, 25 years old. North America is 40. Canada's 42. The median age of a Canadian is 42 years old. The median age of someone in India is 25. Where do you think the growth is going to come from? It's going to come from the places that are set up, that are just about to have their 3, 4, 5 kids, And that's where the developed world was coming out of World War II. In a world where growth is constrained, covered call strategies are going to do better. A ZPay or a PYF are going to do very well generating yield. When the markets sell off, you get longer in a ZPay because the puts that they're writing to generate yield get put to you and you buy stocks, but you buy them at lower levels. And then when it rallies, you sell them off and you generate extra yield for the covered call. So I like, in a low growth world, I like these in the portfolios. I would say strongly avoid any of the companies that don't have good balance sheets in ZPYB. So Apple is in there, but Apple has a pristine balance sheet and I wouldn't worry about those. They're not going to be going to the government for support here, and they're not going to be restricted on share buybacks like the airlines, like some of the banks, etc. So if you're looking to short things, SPYB would be a short candidate, or any of those individual stocks in there that don't have clean balance sheets. I would contrast the BMO ZGQ ETF, the global quality ETF, the quality factor, one of those things Kevin was talking about. These are companies with better balance sheets, not the leverage that a lot of the crappy companies have. And then technology, another way to service the growing world and the developed world and the whole new online world that we're heading into. Cybersecurity, artificial intelligence, robotics, the Internet of Things. These are all ETFs that are going to play, including clean energy.
Here, guys. So Q&A. So Megan, so did you get this one? No? So it's now a good time to go into the travel tourism industry. So basically, no is the answer. But Megan, again, I don't know what kind of investor you are there. It's all about risk. And you know, this is going to be one of the last industries to come back fully on. You know, people are business travel, everything's going to be cut down significantly. So it's speculative, but it's also been beaten up a lot. And I would not buy it on strength, absolutely. In the next major move down, if we do see the S&P below 2,000, I think, Megan, at that point, you can try to catch some of the falling knives there, but the sector's not going to come back to what it was for years and years and years. So something to keep in mind there. Gary asked about gold and gold ETFs. Do I see weakness in the gold market? And so a couple things on gold. First of all, the GDX went from 32 down to 14 back to 29. If you think you can handle that volatility and not be shaken out and stopped out, then okay, fine. But really, guys, I love gold. Gold's going higher. All these atomic bombs at central banks and money printing are wildly bullish for gold. But there's going to be volatility here, and you can't let the noise shake you out of the position. You've got to have your thesis and understand that the probability is very high. It plays out. The path on how we get there is going to be very, very difficult. You buy dips. Someone said they had 25%. Should they buy more? So I can't answer that. But what I can tell you about concentrated bets is if you had 50% of your portfolio on that, we saw another drawdown from 30 to 15 and all the way back. Gary, if you can handle that and you're not going to get shaken out because you've seen your portfolio get cut in half, then fine. But if that volatility is going to cause you anxiety and you won't be able to get through it, you just can't do that. And it's not just gold. It's anything. Anything that you're overly concentrated in can shake you out in this volatility period we're going to still, we're in. It's not over. Okay. Jagish asked about REITs, and my comments were, before I got cut off, was apartment REITs. So I think the demand for residential is going to be massive in the years to come. The unaffordability and so the millennial demand for rental properties, the immigration demand, you want that. But there's going to be 5 to 20, 25% of businesses that aren't going to make it. Retail, strip malls, shopping malls. those aren't coming back. Even in the commercial space, my business partner and I, the whole firm's working remotely now. I'm like, hey, maybe that's going to be something that every business is going to be thinking about. They can do more of, less air travel, less meeting space, all those kind of things that are going to have less demand for commercial. So we'll see how it plays out. But I think rather than buying a broad REIT ETF, you might want to go to special purpose REITs that are more likely going to come back more. And some of those apartment REITs have come back, some of the strongest already. I'm healthy, 80 years old. I've lost 40% of my $180,000 investment. I think that means $40, not 40%. That might be a typo there. What should I do with my 140? So John, I can't give you any advice. I know nothing about you. Is that all the money you have? Do you need this to live off of? Are you going to draw out, $15,000 or $20,000 a year? So without knowing that, I can't help you. And what I would suggest for John and anybody else who's in that, asking that question, go to a trusted financial planner, someone who's going to do that plan for you without a motive to sell you securities, to sell you a mutual fund on the other side. So in other words, a fee for plan. And if you have a good planner, folks, that plan, depending on how sophisticated it is, could be $1,000 or $2,000 at the low end. So you're talking about, $200 to $500 an hour for a really quality planner, somewhere between 5 and 10 hours of work. So that's the $1,000 to $2,000 range, to as much as $5,000 to $10,000 if you have, corporates and family trust and businesses. And so what is that going to look like for you? And that will help define how much risk you should take, how much money you need over the next couple of years in a rainy day fund, in GICs, in a laddered bond portfolio, compared to how much you should put at risk for longer term growth. Okay, so John, forget about what to buy here. You need to know that first before I can tell you what to buy. Now, if you were to tell me, Larry, I don't need that $140,000. I'm going to leave that to my grandchildren. Then I would say go maximum growth, right? Because it's not for you, it's for them. And look at some of those internet things that I talked about, the next wave of technology, cybersecurity. John, just don't do that today. Wait for the market to go down again. David asked, with everything running amok, I'd love to think we're on the road to recovery. Is it time to sell short? David, I've covered that comments today, and for everything that I have, I've got pretty much maximum protection on my portfolio. We're in a far more sleep at night mode in the portfolios now than we ever have been. How safe is the yield on ZWC and ZWS and ZW? So these are the covered call ETFs. And do you foresee the dividend having been cut? So Dusty, last week I talked about dividends being cut as one of the factors we looked at. And yeah, dividends are going to be cut, especially for the companies that have to come hat in hand for support from the government because they have crappy balance sheets, no rainy day funds, and their revenues have been impacted by this global crisis. And so dividends might be suspended for a decade for some of these companies. Now, in the BMO screening, these are companies that have high quality, good, clean balance sheets, but it doesn't mean that in the interim, when their revenues are under, they might not defer or delay or suspend or reduce dividends. The yield that comes off the covered call as volatility goes up increases. So you're going to get more yield from that, and that might compensate for some of the decline in yield. Adolfo, what are your thoughts on Thursday's announcement by the Fed to inject 2.3? So I covered that a bit. So this is the atomic bomb, and this is not QE to stimulate. This is the world shut down. It shut down in a matter of weeks. This is the worst financial crisis, economic shock since the Great Depression. The unemployment rate is going to be different parts of the world, 15 to 30%, maybe higher in some places. And it's going to be with us for a while, and those jobs people aren't going to get back to work. So are all bad things priced into the market, Adolfo? Not a chance. Okay, that's my opinion. I might be wrong on that, but I don't think so. Yield for ZWU and ZWH consistently very high. Large portion is a return of capital. So it isn't a return of capital. There's two types of returns in ETFs, and the ETFs that do not have the underlying dividend yield and support will give you back some of your own money. But there's a so, for example, if the ETF 1 month has 100 million in it, and the next month has 200 million in it, but the dividend payout or earned that month was, like 0.5%. So does it make sense at the end of the next month to pay only 0.25% to 200 million in unit holders versus the dividend earned for 100 million? Or does it make sense to have a return of capital so that everybody gets 0.5%? And so there's a good return of capital and there's a bad return of capital. The bad return of capital is when they're giving you more money to artificially boost your return. The good type of return on capital is when lots of money is going into it, it's growing, the underlying dividends are solid, but because of the growth, they've had to give a bit of capital back so that everyone gets the same treatment. Oh, Paul, hopefully that answers your question. And I would say call the ETF provider to know for sure what type of return of capital it is, because when they report it, they don't tell you. In the current market climate, would I use inverse ETFs? They're fine. I talked about some other things to use. If you go short and the markets go up, obviously you lose money. If you are long a basket of good paying dividend stocks and you use option strategies like I identified to hedge, your market risk is neutral, your yield is positive, and it's better than trying to go short. So Mel, what's good for you? Okay, so it depends. Sleep at night. If you're going to get anxiety if the market goes up and you're short, and that's going to stress you out and you cover at a higher level, that's not going to work for you, Mel. So again, what kind of investor are you? That really defines what you do here and how appropriate it is. So far, U.S. and Canadian markets have recovered in lockstep. Do you see this diverging in the future? What's the main driver? U.S. dollar strength and so forth. Well, so support for the energy sector. So as long as Donald Trump's president, you'll get tremendous support in the U.S. If the Democrats take over, you're going to get less support, but you're still going to get support. As long as the Liberals are governing in Canada, you're going to get no support for Alberta and the energy sector, as far as I'm concerned, in Canada. Yeah, they'll tell you they will. They tell you they care. But Trudeau apologized to the world twice over the last 3 or 4 years about Canadians' oil sands. And if he was smart, I actually said this in an interview on CBC yesterday. They didn't play this part. They clipped it out. But what I had said here was, and if you're smart and you understand that Canada is actually, on a world basis, a relatively low-cost carbon emitter compared to the awful working conditions and behaviors in places like Nigeria, Venezuela, Saudi Arabia, Russia, that have horrific working conditions for many of the people, that use child labor, that burn oil to create energy and have bigger carbon footprints than we do here in Canada. So if you're smart as a government, you recognize that Canada is actually, on a global basis, a low carbon emitter. We should be competing with these other jurisdictions that are higher carbon footprint emitters. We should be building pipelines to our coastline so we can sell our product to Japan that now buys it from Russia, and the world overall is better off. But recognizing all along that 50 years from now, we hope we don't use crude oil at all for anything to power anything but an airplane, because I don't believe we'll ever see an airplane fly without crude oil. So there's always going to be a need for it, but the world is moving to less, and I'm very green, and I believe we're environmental policy is very important. But if a government is smart, they balance the economic considerations with the environmental considerations, which our government currently in Canada that doesn't. And so for that reason, I'm underweight Canada in terms of energy, in terms of completely ignoring it, other than a company like Suncor, which I recommended recently, because they make the vast amount of their money not mining for crude oil, but refining it and selling it at the gas station level. So that's a much better way to play it in Canada versus some of the more speculative names. In addition, they've got a very good balance sheet on average, and a lot of the players are not going to make it. And the Suncors of the world and the big balance sheets are going to come in and clean up those assets at multi-decade cheap levels, which ultimately is good longer term for them. We're getting close to the end here. So oil prices, yeah. So OPEC and Plus is trying to figure it out here, and at least for the short term here, unless they're going to cut 20 to 25 million barrels of oil off the marketplace over the next couple of months. Unless it's at that magnitude, short-term oil prices are going to remain pressured. On this recent rally, I wrote calls on the oil positions because I think they're not going to cut enough. They don't really get it here, how big of a demand hit there is, and how much more longer term it's going to be than they think it is, or would otherwise like to believe. Want to make some upside at these times. Well, if you want to make upside, I think you've got to play the downside here. So my thoughts on using volatility so using VIX ETFs, the smartest people, Jeff, on the planet get blown up using these things. So I don't recommend using the individual investors try. I don't. But if you understand options and you understand call spreads and you understand what that means and how to trade them, then I think you can take measured bets using volatility. So you buy a call on the VIX and you sell a higher call. It's a call spread, and that gives you a defined level of risk. And what you look at for is a 4, 5, 6 to 1 payoff, but you're making bets. So I would say over the next 2 months, are we going to get another big sell-off down to the lows or lower? So yes. So is VIX going to spike? The answer is yes. So what is with VIX at 40, what is a 50, volatility trading at today? What's the premium on that versus a 70? Because we're probably not going through 80 or 90 again. And what's that call spread trading for? And figure that out. So that's how I would do it if I was doing it. And to be clear, I'm not doing it. Or look at something like some of these black swan ETFs that play that tail risk embedded in their strategies. Roland asked, I compared the last 3 months. However, ZPay unit value is back at par. PYF are down. So can I call? So they all use different strategies. So ZPW, which I don't use anymore, and I've sold out of most of, not completely out of yet. They're only writing puts. So there's no upside capture when markets recover, other than the put premiums declining to zero. ZPay owns ETFs and makes money when things go up. PYF does it differently than BMO does. So purpose strategy is different than BMO. They're both active strategies, so they're going to have different types of returns. And so you really have to actually talk to the portfolio managers, look at what's on their website, understand their strategies, and get comfortable which one might do better in any market environment. And so far, BMO has done a very, very good job with ZPay, to be sure. As an example, I own some ZWH in my portfolios, and that's the covered call overlay. And I sold my ZWH out on Thursday to buy ZPAY because on a move down, I'm still getting my yield, but ZPAY is going to give me a better experience on the downside than ZWHs. So those kind of trades make sense too. I don't own any U.S. stocks directly, would like to convert some cash to U.S. dollars, buy some U.S. companies. Question is when? And I've talked about that. So below 140 here, CAD to US is probably a good time to do that. I think 146 is probably the worst we're going to see, but if the Canadian government doesn't start supporting better the energy sector, there is a risk that if this is elongated in terms of the economic hit, that the Canadian dollar continues to weaken. So I'm okay with buying the US dollars at current levels. I hedged everything at 146. At 140, I started buying back, and if we get to 138, I'm going to buy more, and 136, I'm going to buy more in traded terms, more U.S. exposure at those levels. Only got a couple minutes left here. Yeah, so real returns, definitely I talked about real returns, but in the next year or two, we're still in a deflationary environment, not an inflationary environment, and we're not going to have inflation until incomes start rising, people start going back to work, start spending money. There will be supply shortage, price inflation. We'll get price inflation here on food because Canada imports fruit and vegetables and products from outside, and we're a net importer. So in economies that are net importers, there's going to be more inflation as their currency's weak and they have twin deficits. So those are some of the considerations, but we're not going to get runaway inflation, Arnie, until incomes go up. And that phase will be coming. There will be more corporate governance on paying people better. There'll be legislation. You're not allowed to buy back shares unless the bottom quarter of your, salary range is not more than X percentage of what your C-suite makes. All that stuff is coming. You better believe it is. And we're going to have less capitalistic and more regulation around that because the corporate actors and the bad ones have been abusing the system. And inequality is a big, big thing, I believe. And we will see the political vote move more and more and more towards the left type policies. I believe that very, very strongly. Once we're on the other side, the governments keep borrowing and printing, what will happen? So I've covered a lot of points there already, but I think we are in for an extended period, at least a decade and maybe longer, of really, really anemic growth globally. And as the debt levels mount, as they have to monetize more, as they have to keep interest rates low just to keep things are just going to slow down and grind to a halt. And we will get an inflationary shock at some point. And that will be even worse for the financial system because interest rates will go up and equities will perform very, very poorly in that environment, not unlike we saw in the 1970s. But inflation this time around is going to be for a different reason than the strong unions of the 1970s. But I would not be surprised if unionization didn't start to pick up in a big way as supply chains started to get more domestic and jobs started to come back here. So that's something to think about as well. When you think about the world just recovering and this being just a shock, and it isn't. There's a material sea change to the world coming, folks. Worried about the market, sold my bank shares, buy back in, yeah. So yeah, absolutely. But the good dividend payers, the telcos, Canadian banks are pretty solid here. The vast, vast majority of their revenue is fee-based. And while there will be some pressures, they only pay out about 50% of their earnings. So Canadian banks are really well run from that perspective. But there are real estate loans. There are considerations that in the next few years are going to, at a minimum, stop dividends from going up. But I do believe we may see some of the Canadian banks cut dividends a little bit. Not a lot, but a little bit, the longer this plays out. And that's it. So folks, we're longer than our hour and a half. I do apologize for the technology issues that we had here. Sorry very much for that. I know it cut out some questions, but please, 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 if you need help with your portfolios, if you want custom portfolios, reach out to us. Go and look at ZZZ portfolios, what we're doing in the 3 BMO funds, not only the ETF, but the other 2 that may be appropriate for you. Buy the discount class funds. The MERs are similar to what the ETFs are. There's no additional cost there. Consider fee-based financial plan. For the women out there and some of the men, have a look at Golden Girl Finance. It's an educational portal that is specifically designed to talk more to women about financial issues. And for the financial advisors out there, go have a peek at our portfolio managers platform, because maybe that might be interesting for your clients. And by all means, if these webinars and our roadshows across Canada and our focus on education is helping you through this crisis, please, please, please consider supporting cancer and leukemia research, specifically at SickKids Hospital. $20, $50, $100, $500, whatever you can do, or dementia and Alzheimer's research at one of the world leaders in the Baycrest Hospital right here in Toronto that does phenomenal work for people struggling with those issues. 2 very, very important charities for us here at ETF Capital Management, and for Jared and I personally. So thank you very much, everyone. This will be available on replay, and we will see you Thursday night this week for another version of helping you navigate through COVID-19. Thank you very much.